Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. Okay, this part will still be a bit of a long commentary. There's a whole lot to recap and discuss, and as usual, limited time to do it in. I'll try to keep it short. So, the basic drivers are still the same here. The market has been moved higher for many months now by the same key patterns. They are the middle time, currently at 17,520 of them, and most recently by the upper time, currently 21,015 of the huge yet shallowly bullish 2017 to 2018 bullish shift pitchfork. The upper time had capped the market back in September, October, and 2 weeks ago, though it had been assisted when it had been breached. The next pattern is the October 2020 to March 2021 bullish shift pitchfork. Notably the lower time in September and October, currently at 18,525, and the middle time as resistance in October, and as support of sorts last week as well as this week. Currently that's at 2840. This second set of times showed the more recent bullish angle of attack. The lower time was supported back in April, late September and early October, in conjunction all of the time with the slowly rising long moving average, currently 18,410. Something to remember that. Now, I appreciate that many lines are obscured by labels, but please believe me when I say these will become clearer should the market approach any of them. I'd like to remind you once again something I originally said now some 19 weeks ago, and I quote, "Whilst these two pitchforks are in operation, this market will still have the bullish incentive even if sometimes it looks like it is missing." End of quote. Hence, these are the core drivers of this mildly bullish market. Okay, so moving to some of the more recent overall action. If we look at the September action, a number of key features pop out. To start with, the high and low of September, which resulted in a monthly key reversal up for the month, also helped draw a newer bullish shift pitchfork for the April to September move. This pitchfork has already seen action with the middle time, currently at 20,115, recently acting as an attractor. Indeed, this middle time acted as a base a few weeks ago for a significant try higher up to test the previously mentioned middle time of the October 2020 to March 2021 bullish shift pitchfork, as well as the upper time of the 2017-2018 bullish shift pitchfork. Okay, so hold on to these thoughts for a moment. Now, I spoke here 6 weeks ago stating that all this was getting very, very interesting, and the reason for this is that it's still one that is valid now because of a key piece of action. You see, if you remember, September was a large monthly key reversal down, but then October, on the other hand, was an even bigger immediate countering monthly key reversal up. This has led to the latest addition to this complicated mix. Now, I revealed this 5 weeks ago, and it's to look at the whole action from late June to date as a really big diamond pattern. I admit it is a little lopsided to the top right, but I hope you can see what I'm talking about. Now, diamond patterns can be tops, bottoms, or continuation patterns. This one can only be a top or a bullish continuation pattern. So to the details. The diamond has a lower uptrend trend line currently at 18,940 and an upper downtrend trend line currently at 2670. Now, as you know from my previous commentaries, I've been paying close attention to these two key trend lines, and as you will also know, the upper trend line was breached 2 weeks ago. However, it was a false break higher, as there were only 2 days the market was above the trend line, and there were no closes over it, though there was a close right on it 3 Wednesdays ago. Interestingly, the subsequent pullback down only really dropped as far as the congestion around the June and September highs from 2014. Respectively, these are at 19,995 and 19,940, where prices slowed and tried to stay above. All this action is based around the middle time, currently, as I say, 20,115 of the April to September bullish shift pitch fork. The question now, which way will the market break out of this diamond pattern? Additionally, will the next break be real or another false break? These are the current forces at play here, in what in reality is a very confined space, despite ostensively and superficially some wide ranges. You see, the underlying pair of bullish forces are now pressuring the market higher. They are the rising short medium moving average, currently at 19,555, and the medium moving average, currently 19,465. Additionally, all this has happened and still is happening in a relatively short period of time. For example, 3 weeks ago we had a weekly key reversal up, which is how we ended up talking about the upper trend lines for the diamond pattern. Overall, I'd watch the top side. Why? Well, because it ties in with the general mild bullishness of the market, and the upper trend line of the diamond pattern is the closest. LME 3-month zinc. Since the fall down the far side of the mountain in mid-October and early November, prices have seemingly established a range between the rising medium moving average below, currently at 31.55, and the congestion area and Fibonacci levels overhead between 33.02 and 33.66. In amongst all this is a broken uptrend. It's the old May 2020 today optimized uptrend, currently at 33.51, that I've kept on despite it being broken, as it has been given a pretty good account of the bullish angle of attack of the market up until now. Assisting and running parallel to this uptrend has been the rising short medium moving average, currently at 32.53. This optimized uptrend had shown the bullish angle of attack for many months until it stopped working in October. Since the move down the far side of the mountain, it seems the market may be interested in reacquiring it, especially it would seem once prices clear this 33.02 to 33.66 congestion, which it will do next week. Now, a few additional factors. A little below, we still have the previously mentioned rising medium moving average, currently at 31.55. This moving average had prompted a big question, one that I had outlined 5 weeks ago. It was whether the recent action, specifically the mid-August to mid-November action, was a bump and run reversal top. I'd previously drawn a bump and run reversal top trend line, currently at 30.66, just in case. The reason I deliberately mentioned the medium moving average is the bump and run reversal top trend line lies between the medium moving average, which is above, and the rising long moving average, which is below, currently at 30.32. It is also in the midst of congestion support from May to September between 28.53 and 30.92, but it is slowly, ever so slowly, working its way up and out of that, which might allow us now to see how strong these two moving averages and this singular trend line really are. Right now, these two moving averages and the bump and run reversal trend line seem good enough to hold prices up. The longer the market stays above the medium moving average, the more chance the bearish bump and run reversal top will continue to fail. I've already previously removed a label on it on the daily chart. Now, there is one other and perhaps quite important in the sense of timing event that I would like to talk about briefly. With a day and a bit to go, we are on for a monthly key reversal for this week. If we close tomorrow night, that's Friday, either over 31.83 or under 31.57, then we'll be on. Right now, we are looking at a strong weekly key reversal up, something that may prompt a further series of actions. So watch carefully. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.